The president's very, very clear. The deal is a ceasefire, a negotiation. That's what we give. And what they give is that straits are going to be reopened. If we don't see that happening, the president is not going to abide by our terms if the Iranians are not abiding by their terms.
Hello and welcome to the Week Ahead on Nomura Podcasts. My name is Yuban Paracuelas, Chief Southeast Asia Economist in Nomura here in Singapore, and today is Friday, the 10th of April. The US and Iran agreed to a 2-week truce to be able to negotiate a deal, as you heard in the clip from Vice President J.D. Vance. The agreement was initially met with a lot of cheer across global markets, but a day later, headlines seemed to be suggesting a fragile ceasefire. Brent crude oil prices are creeping back up to $100 per barrel at the time of this recording. We continue to see signs of an impact on inflation, but in terms of growth, it's not as clear-cut yet. I'm joined by David Seif, our Chief Economist for Developed Markets, to discuss his thoughts on the ceasefire and the latest from the Fed. George Buckley, our Chief Economist for the UK and Europe, weighs in on the growth implications as well as prospects of fiscal measures. We preview upcoming data from Asia with Jing Wang from our China economics team in Hong Kong and Sonal Varma, our chief economist for India and AJ. We also feature recent reports on why China can be relatively insulated from the shock and on how we see Asian central banks defer in responding to a stagflationary environment caused by this conflict. Now let's dive in. Okay, let's start with the U.S. Hey, David, great to have you back in the podcast.
Hey, great to be here, Yuban.
A lot of things have happened in recent days, and I guess I'd start with your thoughts about the ceasefire between the U.S. and Iran. From a U.S. perspective, just curious if you think this is going to result ultimately in a deal. Is Trump really having this incentive, maybe from a political perspective as well? With declining approval ratings, he needs to have some kind of an off-ramp, or things are still very uncertain?
Well, I think both are true. Things are certainly very uncertain, especially as we're recording this barely 36 hours after the ceasefire went into effect. I think that Trump really does want to move on from Iran, and as a result of that perception, which we have, and which I would assume Iran also has, Iran is taking a very hard line on things. Now, if you look at sort of what the short-run holdups are, I mean, the Strait of Hormuz is largely still closed, at least at the time of this recording. It seems to be that the short-run issue, more than anything else, is whether Lebanon will be included in this, with Iran saying yes, and the U.S. and Israel saying it was not included in this. It would be, in the grand scheme of things, relatively easy for Trump to ask/force Israel to include Lebanon in the ceasefire, and that might allow at least for some stability over the remaining course of the 2-week ceasefire. I think what is arguably a longer-run issue is that Iran released a 10-point plan, which includes a lot of longer-run issues, which includes many non-starters for the United States. Withdrawal of all U.S. troops from the region of the Persian Gulf, the concession that Iran continues to control the Strait of Hormuz, the lifting of all sanctions, the continued right to enrich uranium, and reparations for war damage. And I mean, none of these is going to be anything that the U.S. is likely to agree to. So I think there is a lot of uncertainty. But I do think that Trump is looking to make a deal here, and I would say more likely than not that this will ultimately result in a deal, even if there is some ups and downs between where we are right now and that deal ultimately being struck.
Okay, got it. And in the meantime, we still have to, as economists, continue assessing the fallout from all of this, including the uncertainty that you mentioned. And as per the rest of the guests in this podcast, I've asked them any signs of this energy shock. Obviously, we've seen some inflation pressures, but is it morphing into more of a growth problem? Is that something that you're seeing as well in the U.S., or is it looking more resilient on that front?
Well, I guess we would first say that it's probably too early from U.S. data perspective to really see much of the effects, and we're recording this prior to the release of March CPI for the United States. But that said, we really don't expect to see too much of a hit from this to U.S. growth, and we really do think that the U.S. is likely to be far more resilient, the U.S. economy, than most other economies around the world. There are a couple of things there that are behind this. One, the U.S. is less energy intensive than it used to be, and than many other countries are. In addition, the U.S. has a completely separate natural gas market from most of the rest of the world. So you have seen no impact of the Strait of Hormuz closure on U.S. nat gas prices, nor would we really expect to see any significant impact of it. And then on top of it, the U.S. is energy independent, and doesn't mean that you don't end up with higher oil prices resulting in a transfer from consumers to energy companies. You do. That is a net negative, to be sure, but it's a lot less of a net negative than the money simply going overseas and being, quote unquote, lost to the U.S. economy altogether. And so those things lead the U.S. to generally be more resilient. Plus, you had pretty strong growth going into the crisis, the war beginning, and that was, I would say, idiosyncratically strong in the U.S. compared to most of the rest of the world.
Okay, so a good starting point there. And finally, David, I guess if you have any updates on the Fed, especially in light of recent data, we had the labor market report last week, which seems to be relatively strong. Any new signals that you're picking up from there?
Yeah, well, I should first reiterate that our view remains that the Fed will cut twice this year. That is, of course, very different from market pricing, which shows a relatively flat curve out to the end of the year and really into next year as well. That's certainly not our view at this point. We continue to think that Warsh will be confirmed, and that when he's confirmed, it will lead to a further dovish shift in what we would characterize as a fairly dovish Fed already. That said, I think that when you look at sort of the delta over the last couple of weeks, it has been towards a bit more hawkishness from the Fed, and so we would certainly flag rising risks from that. There are a couple of things. The first thing, of course, is that we got a blowout number to the upside for March employment that came out on April 3rd. Now, we've seen a huge amount of volatility in U.S. labor data, so I don't want to overemphasize the single print, especially given how bad, say, February was. But when you look at the 3-month average of NFP for this year, you still get 68K, and given how much less immigration there is into the United States, that does make it look as though the United States labor market has not only stabilized, but may even, especially combined with other data that we've seen, be picking up to some extent. In addition, we got Fed minutes on Wednesday. Those minutes, of course, came out after that blowout March print, but were from a meeting that occurred before it. So they were a bit stale. But even there, you saw some signs of hawkishness. Still clearly an easing bias from the majority of the FOMC, but you had some members starting to talk about, hey, maybe we should frame things as two-sided risk. Those would be the more hawkish members anyway. But the idea that, hey, maybe the Fed will hike, we certainly don't think they will, nor that there's a consensus for that, but you're starting to see that come out. And you had some other members say that although they still expected there to be more cuts, they had pushed their timing of those cuts back a little bit. So at least some indication of some hawkish movement, not enough, we think, to counter the overall dovishness on the Fed and the change that we expect to occur when Warsh becomes Fed chair, but certainly something to watch out for.
Yep, got it. Let's leave it there. Thanks, David. Excellent as always.
My pleasure.
Okay, now let's go to London, and I'm joined by George. Hey, George, thanks again for joining the podcast.
Hey, Ewan, very pleased to be on.
Yeah, so very interesting times still, notwithstanding the ceasefire that we've heard. And looking ahead on the calendar for next week, doesn't seem much for your region except for maybe some CPI numbers. And we know just on previous releases that energy prices have started to drive headline inflation higher for the month of March, reflecting obviously some of the impact from the conflict. But I'm interested on growth, George. Are you seeing any early signs from the data that it is also starting to be impacted by the conflict?
Yeah, sure. And as you say, there's not a huge amount of data out next week, but the things that we are looking at are anything which will give us some indication of what is happening to growth. And that tends to be, given the lags involved, it tends to be the survey evidence at this stage rather than the official evidence. So, for example, we have industrial production data out next week for Europe, but it's for February. What's going to be a lot more important is anything on the surveys which tell us how things are being affected. And of course, we saw the Centix survey this week where the expectations balance weakened quite a bit. It's fallen over the last couple of months. This is for April. It's the only April data that we have at the moment, but we will be getting more of that kind of data and survey evidence over the coming weeks that will be very important to watch. I think interestingly, in some countries, we've had some mixed evidence. For example, the UK, we saw the PMI weaken, but other indicators such as the Lloyd's confidence numbers or even the CBI's industrial trends survey were actually not as weak as we thought. And also we didn't really see any big increase in that CBI measure of price expectations. So I think the survey evidence is out at the moment, and it really does depend upon, as has been said many times, how long this crisis persists, how long oil prices remain elevated, because that will be, and by how much, because that's really going to influence what happens to both prices and activity.
Yeah, absolutely. And let's talk about policymakers then in terms of their responses. The last time you were in this episode, we were talking about central banks, starting to push back on market pricing of hikes. Maybe they're less now, but I think there's still some. And yeah, most central banks still saying, rightly so, that it's still too uncertain at this point to make anything out of the situation in Iran from their perspective. What about fiscal policy, George? I'm interested because one could make the argument that fiscal policy could be the more effective policy lever in a sort of a stagflationary type of an environment that we might be dealing with now. So, are you seeing some signs that governments in Europe or in the UK have started to think about or consider rolling out some measures in response to the crisis?
Yeah, there's certainly been some talk about that. If you look at what the European Commission has been saying to European economies, it's actually been the opposite, really, which is, please don't let this energy crisis turn into a fiscal crisis. And it is trying to encourage member states not to deal with this by huge expansions in fiscal policy, because a lot of the countries in Europe simply don't have the room to do so. There are a number of notable exceptions, but certainly most of the larger countries don't have that fiscal room. If you think about which countries are able to offset it, I mean, we know that Germany, of course, is providing a huge fiscal boost this year and over the coming decade or so, both from infrastructure and energy, but it has limited resources. Even Germany has limited resources because of its fiscal rules to engage in massive increases in day-to-day spending. We know France, for example, has also probably the least firepower available, as does the UK, which is up against the fiscal rules. But you've also seen in, for example, Italy and Spain, their fiscal outlooks have been looking a lot brighter. Italy, largely by design, running primary surpluses. Spain, because a difficult political situation makes it tricky to expand or to agree a budget and therefore expand spending. So for various reasons, it's going to be very difficult for countries across Europe really to provide much in the way of fiscal support. That said, I should just mention one point, which is that there has been a discussion about among a number of larger countries in Europe, Germany included, about the idea of the European Commission and European Union taxing windfall profits of energy companies, with the idea that that could then be used to support consumers and firms through the crisis. But that's something which is being suggested rather than anything which is in any final stages at the moment.
Okay, got it. So it sounds like nothing too concrete at this stage yet on fiscal policy, and a bit of a mixed bag in terms of capacity across European countries and the UK. Fantastic. Thanks, George. Let's leave it here.
Super. Thanks, Ewan.
Now let's focus on China, and I'm very delighted that Jing Wang from our economics team in Hong Kong could join me today. Hey, Jing, welcome back to the podcast.
Hey, Ewan, glad to be back. Yeah.
So for the week ahead, we have a bunch of data coming out, including Q1 GDP and some Tier 1 numbers for March. What do you expect there? And in particular, I'm interested, is there anything that could show some signs of impact already from the Iran war or not?
So for next week, we will have a slew of major activity data for March and Q1. So it's going to be a big week for China data. And for March data, we expect a broad-based growth slowdown from the first 2 months, including exports, IP, and retail sales. But the slowdown is mainly because of the unwinding of this Lunar New Year distortions, rather than the energy shock from the Middle East. This year the Lunar New Year holiday is quite late, later than usual. So in general, economic data are biased up in the first 2 months and then biased down in March. For example, export growth was super strong in the first 2 months at 22% year on year, but clearly that's just distorted by the Lunar New Year calendar effects, right? So adjusting for those distortions, we are still expecting a clear pattern of this big divide between strong exports and weak domestic demand, for China, and that has been the case, for past few years. But for the Q1 GDP growth, we are expecting it to remain largely steady and unchanged from Q4 last year at 4.5% year on year. And the main growth driver is going to be exports and also the front-loaded policy efforts to stabilize investment. And to your question about the current energy supply disruptions, we have already seen very clear impact on inflation, both on CPI and PPI. But on the growth side, the impact is still very limited. At least that's what we see from the latest March PMI data.
Okay, very interesting. So looks like from a growth perspective, still holding up a little bit, although you're advising to look beneath the hood because of the still a sort of a bit of a divided economy. Speaking of that, Jing, you published with the team a special report last week, which I thought was very interesting, basically arguing that China will be relatively insulated from this energy supply shock because of the country's self-sufficiency, near self-sufficiency in, for example, power generation capacity. But also, I think one point you made that was interesting was in times like these, like where you have supply chain constraints globally, Chinese exports tend to do well. which again I think is fascinating. Could you elaborate a little bit on the main findings of that report?
Yeah, definitely. Yeah. So regarding this special report, we just want to highlight a point that, China's export sector might, again, benefit from this global energy supply shock. And the reason is very simple. Number one, as you mentioned, is sort of insulated. China's dependence on external energy sources is relatively low. So owning about 16% of overall energy consumption are from imports. And second, the electricity price in China is heavily regulated, and it is significantly low relative to, others, especially in those advanced economies, right? So under this global energy shock and also the global trend of electrification, many of China's competitors in the export sector are clearly more vulnerable to the surging electricity prices and the shortages, right? And the competitiveness of their products will be impaired. So for China, it might gain some advantage from its own stable and modern electricity supply system and its role of being a dominant exporter in global markets might be strengthened again. Right. So then, that's a positive, for China's export sector. But for now, we are still holding our projection of a moderate slowdown in export sector, in export growth, to 4% this year from 5.5%, from 2025. But with this ongoing global shock, we are seeing some upside risk, to our forecast in exports. But having said that, right, this gains from this energy cost advantage could be partially offset by a material damage in the global demand if this energy disruption lasts long enough. But for now, right, that's still highly unclear.
Okay, that's fantastic. I would recommend our audience to check out the report for more details. Let's leave it here. Thanks again, Jing, and hope to have you back again soon.
Yeah, thank you, Yuben.
Yeah, and finally, let's focus on the rest of Asia. And thanks, Sonal, for coming back. I know you've been in this podcast last week, but we just published our Asia Economic Monthly, and I thought we could highlight your piece there on central bank reaction functions, apart from doing some preview of the week ahead. So let's start with the data calendar. We've got the CPI data for India for March. What do you expect there? And importantly, how do you see that fitting with your take from the RBI earlier this week?
Yeah, you've been nice. So, we'll be getting the March CPI data for India, so the first post-war print. We do expect a pickup in headline by about 20 basis points and core inflation by about 10 basis points, so both closer to 3.5%. This is only a very slight pickup and still below the RBI's 4% target. It's been more gradual in India because government has used fiscal levers to actually keep fuel prices unchanged, and food prices are also generally quite stable. So we do think the pickup in inflation will be more in the coming months because profit margins are under pressure currently. RBI this week delivered a neutral to dovish hold, surely less hawkish than what markets had feared. And we thought one of the key messages actually from the RBI was their concern that the supply shock can actually morph into a demand shock if energy disruptions continue for much longer. And they also see core inflation staying subdued over the next 12 months. So our main takeaway was that the RBI is not going to react to headline inflation and that the bar to hike interest rates is high for India.
Okay, thanks for that. Yeah, as you put in your report, it's RBI staying calm. The other central bank we're watching closely this week is the MAS on Tuesday. And our house view is that they will tighten with a slope increase in the senior policy band, 1 percentage point instead of a 50 basis point slight increase. And we think that's more consistent with the emerging inflation risk as a result of this energy shock. And MES seems to be signaling a bit more vigilance in terms of delivering its price stability focus. And then, of course, we think growth is still holding up. It's still actually pretty solid. We'll get as well the advanced Q1 GDP. And that will, in our view, come out at 5.4, which we think is above potential, and therefore giving MES a bit more flexibility and focusing on containing inflation risks. Now, Sonal, on your lead article in the Economic Monthly, which we just published, you did some nice work on estimating where policy rates should be based on the Taylor rules and compare that with our own central bank forecast. So a couple of questions. First, where do you see the clearest case for rate hikes and where do you see those that are least likely to hike?
Yeah, Yuban. So actually, let me take a step back. We are in week 6 of the Iran war, and it is expected to be stagflationary. But it does seem like markets are focusing more on the inflation part and less on the stag or the growth effects. So there are 3 key observations that we actually make for Asia. First is we think this time is different because it is not just a 2022 style price shock, but also a COVID-style volume shock. And Asia's starting position, whether it's on growth, inflation, or where policy rates are relative to neutral, we think it's actually a lot more benign today than, compared to 2022. Second, the impact on growth versus inflation does vary quite significantly across countries, so it's important to differentiate. And third, the response function of each central bank to these macro effects is also different. And this week was a good example of this because we had BSP sounding quite hawkish, RBI more dovish. So when we overlay our analysis of the macro effect of the Iran war, plus the central bank reaction function, we do see a fairly high likelihood of policy tightening in Philippines and Singapore. So both very much consistent, with the house view, primarily because of high inflation. On the other side, we see China and Thailand as 2 countries that are least likely to hike interest rates because both actually have very weak domestic demand and low core inflation. Most other Asian countries actually fall somewhere in the middle of what we call the gray zone.
Okay, yeah. In Thailand, we've been getting a lot of comments as well from the governor today, and seems like, again, they're signaling that they are willing to look through the supply side price pressures, which tells us that growth is still their main concern at this point. On the camp of the gray zone, so India and Korea, why do you see them as belonging to that? And what is market pricing for these central banks?
Yeah, so gray zone, we define it as where central banks could tighten if second round effects are material. But we see that probability at less than 20% right now, both for India and Korea. And the question is, how much of risk premium should investors be building in? If you look at market pricing right now for both countries, more than 3 rate hikes are currently priced in the next 1 year compared to our baseline of both central banks being on hold. And even if oil averages, up, let's say $100 per barrel over the next 12 months, which is above our baseline projections, we don't think these central banks will raise rates by as much as market pricing because domestic demand is still in the early stages of recovery. So we see quite a few divergences between our view and market pricing, which we think presents actually ample opportunities for investors.
Yeah, that's really interesting. So I would, again, recommend our audience to have a look at that report for more details. Let's leave it here. Thanks again, Sonal.
Thanks very much, Yuban.
Well, that's it for now. Thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast from your usual provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.